What if the biggest players in the silver market just made the most expensive mistake of their careers? What if the same institutions that spent years controlling and suppressing silver prices accidentally created one of the strongest buying opportunities of the decade? This is not hype, this is not speculation, and this is not a conspiracy theory. Everything you are about to hear is based on observable market behavior, publicly available exchange data, inventory reports, and real physical supply movements that anyone can verify with a little research. This channel exists for one purpose only, to help you understand what is really happening in the markets, not the simplified story that is pushed through financial television and mainstream headlines. Before we go any further, let me clearly define the timing so there is no confusion. This video is being recorded in the final hours of February 6th, after the silver market officially closed with a settlement price near $77.80 per ounce. That context matters because what just happened in silver over the past few days may go down as one of the most important turning points in recent market history. If you own silver, if you are considering buying silver, or if you simply want to understand how a sudden crash turned into a violent reversal, you need to watch this all the way through, because what just happened in silver was not a failure of the bull market. It was a carefully engineered bear trap. Just a few days ago, silver was trading comfortably above $75 per ounce. Momentum was strong, sentiment was positive, and many traders believed the next move would be higher. Then suddenly, almost without warning, the price collapsed. Silver sliced through $74, then $73, then $72, before briefly touching the $71 level. For investors holding silver during those hours, it felt brutal. Fear spread quickly. Financial media wasted no time declaring the rally over. Headlines screamed that silver had topped. Analysts appeared everywhere explaining why prices were headed much lower. Retail investors panicked, and many sold at exactly the wrong moment. But what most people did not realize is that this move followed a pattern that has been used in the precious metals markets for decades. Silver does not trade like normal commodities. The price is not set by physical supply and demand in the short term. Instead, it is dominated by paper futures contracts traded on exchanges. When large institutions want to push prices lower, they do not sell physical silver. They flood the futures market with paper sell orders, creating the illusion of overwhelming supply. That selling pressure breaks technical levels, which triggers margin calls. Margin calls force liquidations. Those liquidations create even more selling. And once that cycle starts, prices can collapse even when real-world demand is strong. During this recent drop, multiple large bullion banks were heavily positioned on the short side of silver. These institutions were betting aggressively that prices would continue falling. Everything appeared to be going according to plan as silver broke support levels one by one. But beneath the surface, something very different was happening. While paper silver was being dumped, physical silver was being quietly accumulated. According to exchange inventory data, millions of ounces of silver were moving out of deliverable supply. At the COMEX, silver inventories are divided into registered silver, which is available for delivery against futures contracts, and eligible silver, which is privately owned and not available for delivery. During the sell-off, a notable amount of silver was reclassified from registered to eligible. That is critical because it means buyers were not trading paper contracts. They were taking real delivery. Once physical silver leaves registered inventory, it rarely returns. That metal is effectively removed from the market. These buyers were not emotional traders. Industrial users locked in supply at discounted prices because they need silver regardless of market noise. Wealth managers moved client assets into allocated physical holdings. Sovereign-linked entities and long-term strategic buyers quietly accumulated metal without making headlines. These buyers do not care about short-term volatility. They care about availability, and availability was shrinking fast. At the same time, the market was reacting to headlines surrounding Kevin Warsh, a well-known hawkish monetary policy figure. Historically, tighter monetary policy is seen as negative for precious metals. Algorithms immediately sold silver on those headlines. Commentators repeated the same old narrative. But there was one problem with that logic. Monetary policy can influence price, but it cannot create metal. Silver is no longer just a monetary asset. It has become a critical industrial resource. Solar panels, electric vehicles, 5G infrastructure, medical equipment, advanced electronics, and water purification systems all require silver. There are no viable substitutes. Global mine production sits near 850 million ounces per year. Recycling adds roughly 150 million ounces. Total supply is about 1 billion ounces annually, yet demand consistently exceeds that level. Industrial demand alone consumes more than 500 million ounces each year. Investment demand adds hundreds of millions more. The gap is filled by drawing down inventories, and that process cannot continue forever. By late Thursday and early Friday, the market began to change character. Selling pressure weakened. Large buy orders started appearing. Prices stopped falling and stabilized. Then silver began climbing back through $72, then $73, then $74. When silver reclaimed the critical $75 level, risk management systems triggered across the market. Short sellers were forced to cover. Stop-loss orders fired simultaneously. Buying fed on itself just as selling had earlier in the week. But now the momentum was upward. Silver surged past $76, then €77, with volume exploding. By the close, silver settled near $77.80, completing a powerful V-shaped recovery. The breakdown was invalidated. The shorts were trapped. Every dollar silver moved higher forced short sellers to buy back contracts at a loss. The same institutions that pushed prices down were now fueling the rally upward. Some banks appeared better positioned than others, suggesting that not everyone was caught on the wrong side. That is how wealth transfers happen in financial markets, quietly, quickly, and without mercy. This does not mean silver will move straight up from here. Volatility is part of this market and always will be. Corrections are normal. But something important has clearly changed. Physical supply has become tight enough that paper selling can no longer dominate indefinitely. Every dip attracts real buyers. Every attempt to suppress prices removes metal from the system, and that metal does not come back. Historically, silver moves in long periods of consolidation followed by explosive expansions. When those expansions occur, they tend to overshoot what most people think is reasonable. Levels like $85 or even $100 per ounce are no longer unrealistic if supply tightness continues. This past week was not a failure of silver. It was a stress test, and the paper market failed. Silver is no longer just a hedge or a speculative trade. It is becoming a strategic resource in an electrifying global economy. Those who understand this are not reacting to headlines or panic. They are accumulating quietly and positioning for what comes next. The story of silver in 2026 is still unfolding, but one thing is already clear. Paper promises eventually collide with physical reality, and when they do, price has no choice but to adjust.